Hi, and welcome into this webinar on taxes and retirement. We want to talk about a number of different taxes. I'll even share with you later a sneaky tax that I think hits a lot of people and they don't know it. But you need to understand how your taxes can change in retirement versus working. There's some big differences, but before we get into that, got to get the legal disclosures out of the way. None of this is intended to be legal or individual tax advice. I'm a financial advisor. I'm not licensed to give tax advice. I can give tax education all day. But if you have questions about your situation or what's going on in your circumstances, we'd love to meet with you one-on-one or virtually in any of our offices across the Kansas City or Wichita, Kansas area. Some common mistakes we'll see retirees make revolves around the Social Security, and we'll get into some of the tax consequences that can be there, but a lot of questions really you should get answers to before starting your Social Security. We have another class on Social Security, check that out in our library. But these are common mistakes that we'll see that people just start it and don't really understand whether their spousal strategies available. Should they have waited and taken it later? Should they have taken it earlier? But again, we'll dig into more of the tax consequences there because Social Security isn't taxed like ordinary income. There's a weird formula with it. Speaking of taxes, when people take money out of their retirement account, as I'll show you here later in this example, Mark, he takes $1,000 out of his retirement account, but it costs him 40% in taxes. And when people just take withdrawals out of these accounts and don't understand the tax consequences, oftentimes during tax season, there's a lot of people that are in for some nasty surprises. And when it comes time for taxes, you don't want a nasty surprise. Another common mistake we'll see is people when they're just taking money out of these accounts, like I mentioned, they don't understand the tax consequences. Sometimes you don't even need to take money out of the account and it can have tax consequences to it as well. Another question or a common mistake we'll see people make are the fact of they don't know what questions they need to ask. They've been working, saving for retirement all those years, but when it changes from the accumulation phase more into the distribution phase, sometimes people, again, they're grasping at straws on what to ask their advisor. Do they need to go talk to a tax advisor? What's the consequences there? And most people, the reason why we do these classes and these television shows, most people don't realize they've made a costly mistake until after the fact. And that's what we want to do today is we want to let you know what are some of these mistakes that people make beforehand, so hopefully you can avoid them. And another common theme or common mistake we'll see people make in retirement is they'll be receiving incomplete advice. So when we get into talking about Social Security taxation, you're going to see that this is a really complicated formula, and just $1 over here can cause more taxes over here. And if you're not getting a complete advice from the team or the professionals you're working with, unfortunately, the responsibility falls on your shoulders, and it's on you to go around and ask a tax advisor or tax preparer what this is going to do to your taxes, or maybe is it going to cost you more for your Medicare? Again, that's that sneaky tax that I'll get into later that bites a lot of people just out of the blue. But you need to make sure you're getting complete advice when it comes time for your finances. And when you're in retirement, you probably can't afford a 30 or 40 or 50% correction, let alone do you maybe even have the time left in your life for that market to come back. So you need to make sure you have some strategies in place there. But let's get back to taxes, shall we? So the Tax Cuts and Jobs Act, it's expiring at the end of this year, 2025. The House has passed some legislation to start talking about extending these tax cuts. But if Congress doesn't agree on these tax cuts, we will see a tax increase in the year 2026, okay? Now, when Trump won the election, whether you like him or not, he's going to be a force that needs to be reckoned with. And he's saying, hey, I'm going to extend my tax cuts. And that should be quote unquote easy. But if they extend the tax cuts without any cuts in spending, it's going to add almost $4 trillion plus to the deficit over the next 10 years. And then that hurts you by causing more inflation. So a lot of changes are happening right now and changing quickly. So you want to make sure you're staying up to date on this information. And I've heard some people say, well, if he gets away with eliminating income taxes and just goes with tariffs, that sounds fantastic. But it will be a big transition to get to there, and it will cause some short-term pain for potentially some long-term gains. But you want to make sure you have some strategies to avoid these things. There's different types of taxes in retirement. We're going to talk about Social Security, but I want to tell you this. If Social Security is the only source of income you have right now in retirement, you don't have a pension, you don't have any retirement accounts, any investment accounts, any interest from the bank, you probably will not be taxed on your Social Security, just how the system is set up. But if you do have those other things, that's when it causes that double Social Security tax, or I think it's almost a double tax. And I'm hoping that they get rid of it. But again, to get rid of it, it will cause shortfalls as well with Social Security. So there's a lot of things in flux this year. You can't just always pay attention to what's in the media because it's changing so rapidly. Another tax we'll talk today about is regular income taxes. You can't escape those in retirement. And how do those come into play with the Social Security taxation when you're taking withdrawals out of your retirement accounts? Those retirement accounts, you're going to have to take withdrawals out of them someday, whether you need the money or not. And we'll talk about what a required minimum distribution is. A tax that I'm not going to cover too much in today is capital gains. That's for investment accounts, but that's a whole different tax besides income taxes and Social Security taxes. Interest income, I mentioned this earlier, as rates have creeped up from where they were and they've kind of come back down a little bit. This is something we're seeing a lot of people cause more taxes on their Social Security. And if you have CDs or money markets at the bank and you're not needing that income to live off of, oftentimes it's causing you double taxation or aggravating your taxation on your Social Security. And we'll get into maybe some workarounds there or maybe some solutions with that. And the estate or death tax. The estate or death tax is not something we're going to talk too much today, but if you have a large estate, single, I think it's more than about 13 million. If you're married, you can double that almost to 26 million. If you have an estate that's more than that, you need to be worried in addressing estate taxes. But right now, the estate tax or the death tax has such a high exemption amount, it doesn't get a lot of people caught up on it. But I do find the most irritating tax to a retiree is that one right there, number one, that Social Security. So let's dig in and learn some more about that. Taxes on Social Security benefits. Well, just like anything the government does, it's a formula, okay? And we need to talk about the ingredients in this formula before we talk about what the formula is. So for purposes of figuring out if your Social Security will be taxed, they look at 50% of what you're collecting Social Security benefits. Then they pair that with your ordinary income, which could be if you're still working, if you have rental income and any withdrawals from your retirement accounts, pensions, dividends, and capital gains. This is something that we see quite regularly. If you have an investment account that is not in an IRA or 401k, it's just a non-qualified, just a regular or joint brokerage account or a TOD brokerage account. This is something that can cause taxation on your Social Security. And it's really where if you have just a financial advisor, they can't help you with a tax strategy to help avoid this causing more taxes on your Social Security. But when you work with a CPA or tax advisor along with a financial advisor, it's more optimal so they can limit this unnecessary tax that we see a lot of people get taxed with. Non-taxable interest, sometimes that gets me a little bit of weird looks in my classes in person, but that would be municipal bonds. The wealthy will invest in municipal bonds because of their federal tax advantages there, but the income you receive will go into this formula. I'm going to end today's class with showing how there's one kind of retirement account that doesn't get counted in this formula, but unfortunately, a lot of people either don't have any kind of money or any money in those kinds of accounts, or they have very little. And again, so once we have these ingredients, half of what you're receiving Social Security and your other income, then they take a look at you as an individual or married. So let's take a look at the individual first. Once half that Social Security and the other income as an individual goes over $25,000, now some of your Social Security is counting as taxable income. 50%, that's not the rate, that's not the tax rate. It just means through these tiers here, 50% of the benefits that push through this tier will be taxed at whatever income tax rate you're at. And we will get to income taxes right after we finish learning about this Social Security tax. If you're single, after your Social Security and your other income goes over $34,000, then 85% of your Social Security is subject to taxation. I'm going to give you a little bit of a preview of an example we're going to talk about here in a second with Mark. Mark is already in this 85% tier. So when he takes out just $1,000 extra, it hits him at $1,000 for the income tax withdrawal, but it also hits him at 85% of another $1,000 of his Social Security. So he owes taxes on money that he had already had, but it changed how much taxes he owed when he took that withdrawal. For married couples, they don't normally, they don't double these like they do with income tax brackets, but there is an increase here. 32,000 is the threshold for married. After 44,000, then 85% of your Social Security benefits are counting as taxable income. So let's take a look at ordinary income taxes, and then we're going to go back and see an example with Mark when he takes that $1,000 out, how it really hits him in a double taxation way. Ordinary income taxes, they've been all over the place historically speaking. They've been as high as 94% in 1944. 94% income taxes. Man, you got to think to yourself, if taxes had to go up in the future, maybe we get into a political climate where after Trump is done being president, maybe in the next administration, they want to raise taxes. You need to make sure you're taking advantage of these lower tax rates to make some tax moves. Because in 1944, like I said, the highest tax rate was 94%. Of course, taxes have come down, the national debt skyrocketed. The last time they changed the tax code was with these Tax Cuts and Jobs Act back in 2017, and that makes the top tax rate right now 37%. But I want to point out this number. Just about 7 years ago, our national debt was $21.5 trillion. Today, it's more than $36 trillion. And in 4 years, it's estimated to be $50 trillion. This is a big factor to driving inflation. This is why they're trying to cut spending, because it's just not sustainable at this point. But I want to go back to these income taxes and say, how much of this is going to impact you today versus in the future? I feel in the future down the road, it could be even a bigger impact on you than now. So don't lean back and say, oh, this is on easy street. Trump's going to lower taxes. I hope he does. But if he does, you need to take advantage of rolling some of these monies out of your IRAs into tax-free accounts. And again, we'll talk about that later at the end of this class. But when we want to talk about income taxes here, when you hear someone say, well, I'm in a 12% tax bracket or I'm a 22% tax bracket, that doesn't mean all their income is being taxed at that rate. They had to pay some taxes at 10, then some at 12 before they're paying at the 22%. One of our CPAs that we work with, Joshua Sikora, he told me this a long time ago, and it made things click. Think of tax brackets, think of them like tax buckets. And the first bucket is 10%, and when the water fills up that first tax bracket or bucket, those dollars are taxed at 10%. Then any overflow, then you start paying on the 12. Well, in this example I'm going to show you with Mark here later, he's in the 22% tax bracket. But he doesn't understand how when he takes this money out of his IRA, it changes the taxation of his Social Security. He'll find out when he goes and files his taxes that he owes more in taxes. But we're going to end the class today talking about a strategy to figure out, are you maximizing these tax brackets or buckets? And again, I want to point out, if they do not pass tax reform this year, the 12 goes to 15%, the 22 goes to 25, the 24 goes to 28, 32 goes to 35, and that standard deduction gets cut in half. So taxes have been, to say it kind of in a cheesy way, taxes have been on sale the past 7, 8 years, and we've helped our clients maximize that. But this is why tax planning is so important, because if you're not using all these dollars in these tax brackets, you could be unwinding some of the long-term tax effects or consequences to your retirement accounts. But unfortunately, most people don't get tax advice every year. They just go have their taxes done. So now that we kind of have an understanding of the Social Security formula and the income taxes, let's take a look at this example here that I told you about. So this is Mark. He's retired and he has a taxable income of $42,475. Now I stress the word taxable because he has other income, but he's not being taxed on all of that. Why? Well, some of it is the standard deduction, but what comes in line before the standard deduction is this Social Security formula. See, Mark is collecting $38,000 a year out of his IRA to supplement the $25,000 he's receiving in Social Security benefits. Well, so if you can do some quick math there, well, 38 plus 25, that's $63,000. Again, he's not being taxed on all that for two reasons. The standard deduction, but what comes in line first is the Social Security formula. Mark, he's wanting to take a little bit of extra money out to go on a trip and go see a concert road trip with his buddies, and thinks, I need to maybe call up my advisor and have him send me some money just to make sure, I have some stuff to buy some meals and maybe buy some souvenirs. But he doesn't understand how this is going to drastically change his taxation on his Social Security. And I want to point out here, he's not making $1 million a year. He's not got a large income. This is why I am a proponent of Trump eliminating the tax on Social Security, because this tax trap hits so many seniors that are collecting Social Security and they don't even understand it's going on in the background. And it's important to know how this could be impacting you. So when he takes this $1,000 out, he calls his financial advisor, hey, can you send me $1,000? And the financial advisor says, yeah, do you want us to owe tax or want us to withhold taxes? And Mark, yeah, I don't like owing taxes. I want to make sure I have enough withheld. How much should I withhold from this withdrawal? The financial advisor says, well, I'm not licensed to give you tax advice. Have you ever had that situation happen to you? I've heard that situation from countless people that say it's very frustrating. They don't understand why they're paying for this person to help them when they can't answer all their questions. So Mark is left to it on his own. So have you ever thought, I don't know something, I'm going to go look on it on the internet, right? We search on the internet and Google for it. But how do you know what to search for or how do you know what you should search for, and how would you know if you're missing something? And that's what's going to happen to Mark here. So he looks at the tax brackets and says, oh, $42,475, I guess that means I'm in this 22% tax bracket. And he's right. But where he's not right is on how much he'll owe 22% on. Because he thinks, in his head, well, if I just take this extra $1,000 out, I only owe another 22% in taxes on that. But he forgets, or maybe he's unaware of how that's going to change how much of his Social Security actually will be taxed. So let's take a look under the hood what happens here. Before the $1,000 withdrawal and after. When the only physical difference is Mark collecting $1,000 of income. But how this is going to change what's called his adjusted gross income, or his AGI, it's going to increase it by $1,850. And if you recall back to those Social Security tiers, he's single, he's an individual. Once half the income and the other, once half the Social Security and the other income goes over a certain amount, 85% of that now counts as taxable income. So when he takes that $1,000 out, yes, he owes the 22% on the $1,000, but what he's not realizing what's happening is he's changing how much in taxes he'll owe on his Social Security, and he owes another 22% on another $850 of his Social Security, because again, of those tiers, the 0, 50, and 85%. So if you do the math there, he took $1,000 out of his account, but it cost him $407 in federal taxes. This is not a surprise you want to find out when you go file your taxes. Had Mark had a tax-free retirement account that he could have taken that $1,000 out, it would have helped him avoid this situation in its entirety. But this is just a classic example of time and time again, where if you're not getting tax advice with your investment advice, it's probably costing you money somewhere, all right? Retirement accounts. These IRAs, 401ks, I've heard it from many people over my career. Well, when I was working, I wanted to put money into it and I got a tax deduction. And then, I had to do enough to get that match because my employer was giving me a match, and that's just free money. If I wasn't getting that, that's foolish. I agree. But you have to understand that one day, whether it's you, your spouse, or even maybe your children, someone's going to have to pay the taxes on these accounts. And like I said earlier, if you can make sure you can maximize and take advantage of these lower tax rates that we have now, we have no idea what taxes will be in the future. But Washington, D.C., and the government, they tend to like to increase taxes over time. So you need to make sure you're checking out if this is an opportunity that you can maximize for yourself. So these retirement accounts, there can be many different kinds. IRAs, 401ks are the most common. If you're with the federal government, thrift savings plan. If you're a teacher in Kansas or public employee in Kansas, you got CAPERS, 457s, 403bs. There's all different kinds of accounts. But the important thing I want to get to you across today is the fact that if you've not paid the taxes on these accounts, someone's going to have to. One day, you're going to be forced to take withdrawals out. Now, they've changed the age a couple times with this. The original age where you had to start taking money out of these accounts was 70 and a half. I don't know where the half came from. I don't know a lot of people that celebrate their half birthdays. But this 70 and a half, if you didn't turn that age by the end of the year 2019, then they made the age with the Secure Act 72. But then if you didn't turn 72 by the end of the year 2022, then your RMD age is 73 if you're born before 1960 and 75 if you're born after 1960, okay? But I want to talk to you about this example. And this is a gal that came to one of my classes, Judy. Judy, she wanted to take her Social Security as early as possible, but she was concerned about the tax consequences, and rightfully so. Now, she said she could just live on just about her Social Security and some other sources of income that she had, but she had $100,000 in her retirement account. And I looked at Judy and I said, well, you're still pretty young. You're 62. And if over the next 10, 12 years, this account doubles to $200,000, your required minimum distribution is more than 3.5% that first year. So that's more than $7,000 in a required minimum distribution. Now, again, they've changed the ages, and so make sure you're staying up to date on what those are. They've now changed those ages, like I said, to 73. They've also reduced the penalty as well down to 25% instead of 50% if you were short taking it out. But again, back to Judy's story. Judy had just had this retirement account, and it was really her emergency account in a way. She goes, I don't need to take anything out of it. Well, if you don't take anything out of it, that just aggravates down the road what your RMD or required minimum distribution could be. And so if Judy's situation where she would have been forced to take out an estimated $7,000 plus when she turned that age and had to start taking withdrawals, if you can imagine how the $1,000 tax had an impact on Mark, can't you imagine that the $7,000 impact of income changing for Judy could have on her situation? These are the kinds of surprises that a lot of people don't want in retirement. And if you're not going to have these surprises, it's really important to be working with a team that can help you with the tax consequences and the investment consequences or ramifications. Now, if you're married and you lose a spouse, it's very unfortunate when that happens. It's very, very demoralizing. You've lost your partner. But now I need to tell you that you'll be paying more in taxes faster. What does that mean? Well, if you're a married couple and you're needing around $96,000 of income, that means that you are in the 12% tax bracket, okay? Now, if you lose a spouse, you can no longer file as married. And the surviving spouse, if they need $96,000 a year to keep the house going or the expenses, they're now pushed into a higher tax bracket, into 22%. This is an uncomfortable conversation that I've had many times with people when they lose their partner along their way in the journey of retirement. It's not a comfortable conversation to have, but it's a beneficial conversation because if the taxes are going to change from married to single, if it's going to increase your tax costs, sometimes there's things we can do to take income out this side of the calendar year and still get the married rates before the end of the year happens. So I hope you and your spouse, if you're married, have a long, healthy retirement. But unfortunately, when you lose a spouse, there's a big impact there. And I met with a gentleman just the other day. He did his mom's taxes and he finally said, this is getting too complicated for me. I don't know what's going on. He did not adjust the withholdings when his father passed away on his mother's income, and she owed a lot of money in taxes. This is a tax surprise that will be coming for you because it's very rare, and I say it's very rare, normally it makes the news when both of you pass away at the same time. It's a high degree of probability that you'll lose a spouse or one of you will pass away in retirement. You have to understand that taxes will then start to work against you when you go from married filing joint to single, okay? This is the sneaky tax. It's called IRMA. IRMA is an income-related monthly adjustment amount, and it's meant to help offset the cost of healthcare in this country as a tax. This was introduced, I believe, when the Affordable Care came out, or sometimes called Obamacare. This is a tax that catches a lot of people off guard for the primary reason it takes about almost 2 years for it to show up. Now, I help a teacher on the Kansas side. Her name is Marcia. And Marcia, she went to one of our taxes and retirement classes, and she said, I think it would be wise for me to be getting tax advice with my investment advice. And that first year, I'll never forget, she called me up about October, November, because that's when typically these letters will go out. And she said, Matt, they're going to withhold $75 a month out of my Social Security check starting in January. Why? Well, Marcia, I think I might be knowing what's going on there, but if you can bring in the past couple of years of your tax returns, I want to have one of my tax advisors or a CPA look at this, and we'll have this conversation. So she comes in with this stuff, and unfortunately, Marcia had triggered what's called IRMA, this income-related monthly adjustment amount. And if you trigger it by just 1 penny, it's adding $75, $85, $95 a month to your Medicare premiums. And they will just gladly withhold that out of your Social Security check and not and send you that letter. And there's things you can do about this, but oftentimes after the cat's out of the bag, it can be a little bit more complicated. So back to Marcia's story, when she came in with her tax returns and we were looking over this, I said, well, I know what you're taking out of your account to supplement your Social Security, Marcia, but did you take a larger withdrawal one year? And she smiled and she said, yes, I took my grandkids to Disney World. Oh, that's great, Marcia. When you took that withdrawal from your previous advisor before working with me, did your advisor ask you what your income was that year? And she kind of thought for a minute and said, I don't remember him asking my income. This is what catches a lot of people off guard. If you go over these amounts, you don't even understand that you could be triggering IRMA and in a couple years have to pay these penalties. And Marcia was not very happy that her advisor wasn't in the know with that. But again, saving for retirement is one mindset. The distribution phase in retirement is a different one. And most of the time, financial advisors that help you save for your retirement, they're not necessarily equipped to help you understand all these taxes or pitfalls or costly mistakes that can happen just so easily. Now, I mentioned that they changed the law with the Secure Act on the RMD ages. Well, they did some changes with this as well on how you can leave your retirement accounts to your kids, or people that maybe the better way to say that is maybe not your kids, but people that you're not legally married to. If you pass away, and obviously the change was made in the year of 2019 going forward, if you pass away 2020 or going forward and you leave your retirement account to someone that you're not legally married to, they have 10 years to take it all out and pay the taxes on it. So in this example, this is Pamela, age 65. She has one son, Kyle, age 40. And when she passes away, she left $1 million in her IRA to Kyle. Now, if Kyle decides to take that out all at once, that is a big tax hit right out of the gate. And I've been a part of several stories over my career where the children wouldn't even withhold the taxes when they got the money. They said they'd figure the taxes out later, but then come tax time, they don't even have the money to pay the taxes. These retirement accounts are tricky animals as far as when taking money out of them, how they can change the taxation of your Social Security, and when you leave them to your beneficiaries. And the average inheritance, depends on which study you see, the average inheritance can be spent anywhere from 90 to 120 days. And if you have any children that maybe are not good with money or they've had some issues, there are estate planning techniques that you need to engage to make sure these kids don't hurt themselves when they get all this money, let alone hurt themselves from the tax consequences. There would have been a better scenario for Kyle here if he would have tried to take that out a little by little over the 10 years instead of hitting him all at once with the tax bill. And this is something that we see people make time and time again mistakes with, predominantly because they're not getting tax advice. They're only thinking about the investment side. So let's talk about the tax-free retirement account. I said that earlier, but its technical name is the Roth IRA. Now, a Roth IRA is very different from a regular or traditional IRA, so let's talk about some of those differences. The traditional IRA, I mentioned this earlier, you get a tax break. You get a tax deduction when you put money in there. Maybe even your employer, like I said earlier, matches that with that free money. You gotta get that free money. Until last year, the employer could never add it to the Roth. Some employer plans are being updated because the laws have changed, but most of the time we see that all those contributions you made into that traditional IRA or 401k, that you got the tax deduction on, you received the tax-free match or the free money from your employer, none of the taxes have been paid on that. If you put money into a Roth, well, the taxes have been paid there, but there's some caveats down the road. So let's go on this journey together, shall we? As they hopefully accumulate or they grow over time, there's no taxes due on either. Man, this stuff's great. I get a tax deduction. My employer gave me free money. I don't owe any taxes on it as it's growing. My mom always says, and I'm sure you've heard it from your parents too, if it sounds too good to be true, it probably is. When you come time for the distribution phase, when it comes time for you to start using that money in retirement, distributions are fully taxed as ordinary income. They can impact the taxation and often do change the taxation on your Social Security. And then worse yet, you have to take money out of it whether you need it or not when you turn an age, 72, 73, 75, whatever the age is, because they change it all the time. With the Roth money, as long as you've had one open for 5 years and you're over the age 59 and a half, you can take money out of that account totally tax-free. And the money that comes out of the Roth, it oftentimes doesn't have an impact on the Social Security taxation because those dollars don't count towards making more of your Social Security taxable. So if you can think back to Mark's example earlier when he needed just $1,000, if Mark has all of his money in the traditional IRA versus the Roth, and has nothing in the Roth, it doesn't give him any options for choosing tax control. And this is, again, a classic example that we see that a lot of retirees have most, if not all, of their money over here, and they don't have any over here in the tax-free. Well, there's different ways to put monies into retirement accounts. To put new monies in or contributions, well, you have to be still working, okay? But you can recharacterize, you can change it from taxable to tax-free. You just need to know how to do it. So what I just showed you was a Roth contribution, and that's where if you want to write a check out of your checking account, this is kind of a neat thing. If you worked in 2024 and you had at least $7,000 of wages in 2024 and over the age of 50, you could make that $7,000 contribution for 2024 up until April 15th of 2025. That's kind of a neat feature. A lot of the things in the tax code go calendar year. These retirement contributions, you can actually have a little extra time in the next year to still make them for the previous year. Now, Roth contributions, they have limits on them, so you can't just stick $100,000 in there if you wanted to. That'd be nice, but that's not how that works. But what I want to focus on more today is these Roth conversions. Now, there's two differences between a contribution and a conversion. One of them is the time of the year in which you can do them, but the other one is also those limits. So putting new money in oftentimes has a limit, but the conversion, you can do as much as you want. It's just basically paying the taxes on the money that's not been taxed and moving it over to a tax-free account. There is kind of what I would say is there's something that needs to be done here as far as planning and getting information before you do a Roth conversion, because you want to know how much it's going to cost you. You don't want to do $1 million Roth conversion probably all at once. It would be too expensive to do in taxes. So you need to figure out how much room do you have left. How much room do you have left in those tax brackets or buckets? And this is back to where tax planning comes in. So if you're going through the year, 2025, and you get to October, November, and you kind of realize, okay, I don't think I'm going to get any more income this year. This is what I received in Social Security. This is what I took out of my retirement accounts. It's very advantageous to see, do you have any dollars left in these tax brackets? Or again, we call them tax buckets. This is an example from a couple years ago. This is a married couple where they stopped working. One of them was collecting Social Security and they had some rental income. But what I want to highlight here is they had $23,000 left in their tax bracket, or in the 12% tax bracket. And we helped them move $23,000 out of their IRAs that have not had the taxes paid on them, paid the taxes at the 12% rate, because we're of the opinion in the future taxes probably will be higher, helping her and him unwind this tax burden. They have over $1 million in their retirement accounts, and we didn't just say, hey, let's do $1 million Roth conversion, because there was more to it than that. We brought in a tax advisor or CPA to walk through this scenario with us, and we found that they were not going to use all their dollars in that 12% tax bracket or bucket. So it was to their advantage before December 31st to take that money out, pay the taxes on it, and do a little bit at a time. This is a hard thing to do if you're not getting tax planning. Because most of the time, you'll go to your tax preparer in February, March, and April, you'll drop off your tax documents, and if you say, hey, I'd like to do a Roth conversion for last year, 2024, the tax preparer or the tax person is going to look at you and say, you can't do a Roth conversion past December 31st for 2024. We need to look at that going forward. In a way, the retirement system in America is broken. It places all the responsibility on you guys, the retiree, to go out here and make sure you're maximizing your tax situation before the end of the year closes. And if had John and Jane Smith here not done that, they would have wasted $23,000 in that lower tax bracket, that 12% tax bracket, where they can start unwinding these large untaxed retirement accounts, okay? And that's just one of many, many examples there for a Roth conversion. So some takeaways. The tax laws have changed. I'm going to say the tax laws will always be changing. Make sure you understand that when they change, how they impact you, and can you make your situation better, or maybe can you even maximize the tax changes for your situation. Be proactive when it comes time for your taxes. If you have someone that helps you do your taxes, that's great. Or maybe you do them on your own. Good luck with that. But what we find is you need to be proactive with your taxes and have that meeting before the end of the year with your financial advisor and or tax advisor to make sure you're maximizing these tax changes for your situation. Your personal tax map or situation is going to greatly vary based on what other income sources you have. And your income can fluctuate from year to year. Make sure you're maximizing that lower tax bracket of the 10 and 12%. If you're not, you really are missing something there, in my opinion. For the average American, you're going to have other income sources besides Social Security. So you need to understand that while this Social Security taxation formula exists, and it's a screwy one, don't get me wrong, I hope they repeal it. I'm not too optimistic on them repealing it because it will create an $85 billion a year shortfall for Social Security. They've got to make that up somewhere. But understand that this Social Security income is not just regular income. It's going to be taxed more or less based on what other income you have. And if you have CDs at the bank or money markets, those are oftentimes aggravations on people's Social Security taxation. It's your money. You have the right to know what you're being charged without becoming a financial expert. I throw this in this class is because a lot of people, they may work with a financial advisor, but they may not know what they're being charged. And if you want to check out our fee schedule, you can do that at our website at marketadvisorygroup.com. Not only do we lower the fee the more you have, but we also bundle the services where maybe you're getting a discount on some estate planning services. Maybe you're getting help with your tax preparation bill or your tax filing bills, or maybe we take care of all of it. If you're working with a financial advisor or a financial advisory group and they're not helping you with all the other aspects of retirement, I invite you to check out that fee schedule there on our website. You might be pleasantly surprised. I talked a lot about the different personalities in this class that we work with as a team. The tax advisors, or Joshua Sikora, he's a CPA, our estate planning attorneys at Eidelman Law Firm, and our Medicare advisors over in the Medicare wing. If you don't have someone that's helping you navigate all these issues, you can hit that schedule button there at the bottom, or you can call 833-MAG-REPORT. We'd love to have a conversation with you to understand what's impacting you that you're aware of, and maybe some of the things that are impacting you that you're not aware of or it's not been brought to your attention. I'd encourage you to Google us, but we have several television and radio show programs here in the metro area. We do that as a service to make sure that you're not falling into a lot of these traps that people find themselves in and costing themselves costly mistakes. My weekly radio show is called Retire Hour. You can go to retirehour.com to check that out. We'd love to have you submit a listener question to be used on there. But we talk about this ever-changing landscape that is retirement. We've talked about how Trump wants to do away with Social Security taxation, which I'm all in favor for. I just don't know how we're going to make up the shortfall on that. This stuff is a rapidly changing environment, and what I've found is most people want to just enjoy retirement. They don't want to change jobs or learn all this stuff that can impact them. They want to rely on a team, and that's what we talk about every week on the radio show with Retire Hour. Written a couple books, one called The Investor Catch, talks about fees and risk and who's poised to profit more, you or your financial advisor. And if you don't know what you're being charged in fees, come in, have a conversation with us. We'd love to show you what you're currently paying in fees and what's going on in your situation. And if that's all you need and you're happy with that, it's always okay to tell us no. But so many people are saying, no, we love working together with you as a team and this team concept. What's that look like going forward? And we can talk about that one-on-one. One of our estate planning attorneys wrote The Inheritance Trap, Common Estate Planning Mistakes and How to Avoid Them. You don't want to just die and not have an estate plan. You don't want to leave that chaos for your loved ones. You want to make sure you have things spelled out. So if you're in the Kansas City metro area, we have 3 conveniently located offices, one up in the Northland, one out in Independence, and one down at 95th and Knoll in Overland Park. You watched this today, and I hope you learned something, but more importantly, I hope you take action, because education without action is worthless. If you have questions or want to learn more about your situation on a one-on-one basis, call us at 833-MAG-REPORT or hit that schedule below button there, and we get you scheduled in any of our offices across the Kansas area. Thanks for tuning in. Hope you enjoyed it.